Everyone's been waiting for the interest rates to go down. Home buyers are waiting, investors are waiting, developers are waiting, business owners are waiting. Many people have built their strategy on the assumption that rates are going to come down. But what if that doesn't happen and rates do not fall? What if inflation stays high? Inflation keeps going up. This can affect property values, monthly payments, lots of different things. And then what? Welcome back to the JSS Podcast. This is Byron Enriquez, your local finance bro. And this episode is going to be for my fellow finance bros and for maybe some finance bros in training. We're going to get into the weeds a little bit about interest rates and the Fed and markets and how that affects the business and how that affects lending. I think it's just interesting because there's a lot of conversations lately in the news and everything you hear about Fed, a new Fed chair, new Fed policy strategy, the politics that go with that, and are rates going to come down? What's happening with inflation? And there's a lot of terminology that I think a lot of people don't understand, aren't very familiar with. A lot of times it goes over people's heads and, just kind of all over the place. So today I just want to break down some of those terms and some of the minutia that goes with that, just so it kind of helps you understand what's happening and when you hear announcements and that the Fed is keeping rates steady or there's no or it's going to increase even, how that affects and the ramifications that those can have, right? So again, just want to get really into that. So here at JSS, JSS Financial, we're dealing with consumers and borrowers directly. So we feel the pinch of interest rates, right? When interest rates aren't getting lowered, when the cost of capital, when our investors are spending X amount of dollars to borrow money, and those projects are getting go longer period of time, interest rates affect, right? When we're working with some real estate clients and looking to purchase properties and they're looking at interest rates and how that dollar can stretch, interest rates affect. At JSS Capital, when we're talking about lending out money and the return for our investors and how are we going to set our interest rates to the consumer, to the end user at that point, interest rates matter, right? So this is, in my world, these are daily conversations. Right. So there's a lot of misnomers. There's a lot of information that's missing for people. We hear again, I on my TV daily, I have the markets up and, looking at the rates and looking at the Fed and looking at different things. And those are all markers for us to be able to identify what's happening. But it's not directly the rates, right? And I just kind of want to set that straight because I think a lot of people feel that the Fed or the Federal Reserve, for that matter, sets interest rates. They do not, right? So what does the Federal Reserve? What is that? The federal funds rate? What is that rate? I guess, right? So a lot of people don't understand that. So the federal funds rate is an overnight rate. It's a rate that's banks will lend each other money overnight from excess capital that they have in reserves, right? So the government sets that benchmark as in, hey, Mr. Wells Fargo, you're going to let BLA borrow money overnight, right? It's literally overnight. They set that benchmark so it's equal across the board. And that's what that rate is, right? That's not your 30-year mortgage. That's not your credit card rate. That's not your auto loan rate. That's nothing. That is only at the bank level. Does that affect interest rates? Yeah, a little bit, not directly, but it is, again, markers of where we can track, right? It is still very influential in what happens, right? How it maneuvers and how it affects the market. Actually, I would argue that, in the quarterly meetings that the Fed has and the announcements that they make, I would less listen to the rate. I would more listen to the other factors that they're saying. They're talking about, they say, yes, we're leaving the rate steady or we're increasing rates or we're lower rates because And after they say that, because is, I think, the important part. They're going to tell you what their thoughts are on inflation, right? Main thing is inflation's going steady. Is inflation increasing? Is inflation lowering? Right? And we can get into what inflation is. Inflation is the difference between one year to the next of what the cost of a certain good is, right? If a gallon of milk in the year 2000 was $2.50, and now it is $7.50, that is inflation, right? That cost of that same good or service has increased. It's inflated, if you will, right? So that's what those are the part of the announcement that the Fed's making. Another thing that they're talking about employment. Big factor. What's going on in employment? What's happening? Is the employment rate rising? Is it decreasing? Again, a lot of misnomers, and there's a lot of factors that go into the economy and the economics of this. But think about it this way: if unemployment was at zero, meaning everybody had employment, that means everybody has money to spend, inflation would rise, right? And you would think, oh, but that's a good thing that everybody's employed. But yes, everybody has money. So now the cost of goods are going up because people have more money to spend. People are spending more money. People are overpaying and willing to pay for goods or services, right? So one of the things, and I hate saying it, one of the things that controls inflation is unemployment. We need to keep a healthy amount of the unemployment rate at a healthy amount. We're also looking at job creation on the jobs report. Those are important announcements that are coming at the Federal Reserve level, right? Those are the things that I think make for affect rates more. The reason that affects more is because banks, we're always looking forward and hedging and protecting ourselves over what will happen in the future, right? We're making some guesses of what we feel the market's going to happen in the future, because an announcement today isn't going to, affects future lending parameters, affects money that's out on the street, money affects payoffs that are coming in, affects a lot of different things, right? So we're looking for the announcements, and we're looking for the verbiage in between the rate that make a big difference. A lot of times too is people ask, hey, the Fed dropped a quarter point. How come my mortgage didn't drop a quarter point, right? Again, yes, seeing the Fed fund rate lower means you're usually going to see some sort of decrease. But what ends up happening is that a lot of the bankers, a lot of the mortgage bankers, securities, capital markets, all of us that are in this business, we are forecasting and we kind of already know what the announcement's going to be. So you start pricing in those changes weeks before the announcement is made, so that when the announcement is made, we're already in a forward-facing position where we're protected, right? Sometimes it's, hey, the Federal Reserve lowered rates, but yet the banks increased it. Again, because like I talked about, we're listening to the verbiage outside of the rate. We're listening to the jobs market. We're listening to inflation, and we're looking at the jobs reports. We're looking at a lot of these factors that we feel make a bigger difference in the mortgage place, right? The jobs report. If people don't have jobs, can't pay their mortgage, so now we have to increase rates because we're pricing in risk. We're protecting our investors, the bank's investors, right? So those are a lot of the things that they're looking at. So when somebody tells me, hey, what's today's interest rates? I get it almost every day, right? Go to a party, go to any kind of event, go to anything. And it's funny, I was at a family function yesterday. Most of my family has no idea what I do. It's just, and I get it. It's not easy to explain, or sometimes people understand, and they're always like, well, what is it that you do again? And I'm like, oh, I do mortgage. And I just try to keep it simple sometimes. Oh, what are rates at today? It's always that follow-up question. And I wish it was that easy as to say, oh, rates are 5%, right? And then maybe I should just say, give out a number and people wouldn't think twice. But the reality is, what are rates today? There's so many factors. Yes, Federal Reserve, the Treasury, which we'll get into a little bit, all of those factor in rates. but it's also your credit score, what type of property, how much equity is in the property. There's a lot of different factors that come in to determining a rate, right? And all of that makes a difference. So then the question is, so what does indicate rates more often, right? What I always tell people, and the factor that at least, and I'm speaking right now, this is more of just the consumer conventional 30-year mortgage rate, right? We're not talking about private loans, and we'll get to that at the back end of this conversation. What's the real driver? What's a real way to determine 30-year mortgage rates, right? The indicators we're looking at the most is the 10-year Treasury note, all right? And then the first question people ask when I say that is, if you're talking about 30-year loans, but now you're basing yourself off of a 10-year marker, it's a reason for that. The majority of people who get a 30-year mortgage do not keep a loan for the 30 years. It's just the reality, right? I remember a long time ago, and the numbers have shifted, but for a long time, the average consumer kept a mortgage for 3 to 4 years. As much as people said, no, I'm never going to refinance. Every 3 to 4 years, like clockwork, they were refinancing. Either because their equity had gone up, they were pulling cash out, they were paying off debt, they were buying a new house, they were upgrading, they were building on, all the factors that came in. I think that's shifted, and it's gotten a little bit longer because there was a period of time, post-COVID or right at the beginning of the early 2020s to 2023-ish, when rates were so low and people were locking in at 2.5%, 3%, that I think those people will keep their mortgages a little bit longer, and we're yet to see it, and we're still kind of in that bubble period. But on average, the consumer doesn't keep the loan for 30 years, right? So a 10-year marker is where we've set, and we say on average, somewhere around the 7-year mark, it's going to fluctuate, right? So we're willing to forecast, lock up interest rate money for that period of time, because we understand is when we're setting a 30-year fixed mortgage, your rate's not changing. The market changes, but what you're paying is staying steady, right? So if we're using the 10-year Treasury saying this is the interest rates that we're going to get a return, this is the yield we're going to get on this 10-year Treasury note for 10 years, and we know that's not going to change, so then your interest rates can lock in, and you're more aligned with that. Right, the other factor that goes into that 10-year Treasury is the yield, right? Like I mentioned. So the yield is specifically what investors are being paid to buy that Treasury note, right? Anybody can go out and buy 10-year Treasury notes. It's an investment vehicle. It's an investment certificate you're buying, and you put a certain amount of money in. They're going to give you a yield that you purchase at, whether it's 1%, 5%, 10%, 30%, whatever that yield is. It's the interest rate you're going to get on your investment in 10 years, right? So when we're looking at the yields, is mainly what we're seeing is if we're in a market where jobs are slow, and a lot of inflation, a lot of defaults are happening, different things are happening, the traditional 30-year loans are a little bit riskier. So as a market, we have to pay out a higher yield to investors to put their money into this investment vehicle, right? Think about global economy. There is a finite amount of dollars out there, and we're all different investment vehicles are fighting for those same dollars. So you say, hey, I want to pull these dollars into this 10-year Treasury note. I need to make it more attractive to my investors and give them more yield, right? So as we increase the yield to attract investors, because it's riskier times, we're pricing in, it's whatever we're looking at, like I said, the riskier period. So then in order to pay out that higher yield, we're also having to increase rates, right? That's supply and demand. It's just standard. Inverse is also correct, where we're booming, economy's doing great, no inflation, jobs are great, no defaults, money's cheap, right? Money's cheap. There's an excess of investor money out there, where we're saying, hey, you know what? People are buying 10-year Treasury notes. We're not trying to entice them. we're lowering yields. As we lower yields, because, we don't need to entice them with any special pricing to get their money, interest rates drop, right? Standard. That's kind of, in a nutshell, that's really the factors we're looking at, right? Again, that's what, as an institution, as a capital markets, we're taking that data to create our own rates. At the end of the day, every bank, every lender, every financial institution that does lending is also factoring in their own risk appetite. That's why sometimes you may see the difference between Bank of America, Wells Fargo, Chase. Everybody's a little bit different rates because they're pricing their mortgages at their risk tolerance or how much profit they want to make. When us at JSS, when we're pricing loans, and even outside of the private space, we also know that we're competing with other lenders out there. And can we increase our margins and inflate the rate to make more money sometimes? Yeah, we probably could. But will that take us out of the running when you're competing with others, right? That's why competition also keeps pricing equal. Like, gas prices, for example. If you go to a gas station and you see a gas station on one side, the gas station across the street, they're constantly fighting for your dollars. So, and you can always see, well, one guy drops the price, the other guy's usually going to match it, and they're going to kind of stay the same. And it's kind of standard in our business as well. So we're competing with the market, where yes, we want to give out a competitive product where we're enticing clients to want to borrow from us, but yet still build enough margin where we're making profit, our investors are making money, right? So there's it's a kind of a constant balance of how we price things. And again, like I said, this is conversations very, very finance bro-ish. So if I lost you and you need to wake up, welcome back. But this is what I do, right? This is what I talk about. And this is the things that I think makes you a better investor, better borrower, a better investor in real estate and notes and debt and all the things that we talk about on the show. Knowledge, I think, is important to understand because we're constantly we're in the information age when we're being bombarded with data and information. And a lot of times it's learning to filter out the noise, filter out the things and focus on the things that matter to us and our business, in our strategy, in our investment portfolio of what we're looking to do. Of when you're making decisions, whether I want to invest in the stock market, I want to invest with JSS Capital and private money, I want to buy real estate. These are all the factors that you're looking at. If your investment strategy is, I'm going to buy something, hope and pray that the rates go down so I can refinance out, but yet I want equity to increase and my value to increase so I can make more money. And if that's your investment strategy, it's not the show for you, right? I think you're gonna definitely put yourself into a situation where you're putting yourself into a corner, right? The things you want to focus on when you're investing is, yes, the rates is a big factor, but I need to know that if the rates stay what they are or even increase, that I'm still going to make money, right? And how do you do that? You're protecting your basis, meaning what you're buying a property at, what you're buying your investment at, what you're buying your stock at, right? What's that price? Because that price, most profits are made at the purchase, right? So what you're investing in, what you're buying, what's that price? And we call it basis. So that's that entry level that you came in, and then did you add value? What did you use to add value? How much value did you add? Did you put money in? Did you put CapEx in? What is it that you did to increase that basis, increase that value, right? Not the market, not waiting on things to happen. Hope is not a strategy, what I've always told people. It's what is that you're doing to control that value add, right? How are you protecting against inflation? How are you insulating yourself from those factors, right? Your carrying costs, things that a lot of, again, people don't think about. It's if I'm borrowing at this higher amount, and if the economy is where it is, where properties are staying on the market longer, they're taking longer to sell, time is money, physical money, meaning the longer you have to hold a property, it's at that higher rate, it's a higher carrying cost. Your debt service is higher, your utility costs are higher, your taxes are higher, your insurance is higher. Are you factoring in those components into your strategy of how you're going to dispose of your asset, whether it's a stock? Holding time for a stock can change too. And I talk about real estate because this is more real estate centric, but I think you can apply these principles to any type of investment you do. You buy low whenever you can, you add value in any way possible to that type of asset. You factor in how long you're going to hold it. What is it going to cost for you to hold it? What is it going to cost to dispose it? Your broker fees in real estate, your broker fees in your stock portfolio, when you're selling stock, your trading fees, all those things that go in. How does that affect your bottom line, right? So as the market's evolving, as the market's changing, as rates staying still for now, and there's talk of rates actually going higher. Right now we're in a war that doesn't seem to have an end in sight, that just seems to be getting worse and worse. Inflation keeps going through the roof. It's not changing. It's not coming down. Its price of goods are higher than it's ever been. Job creation is not as great as we were promised. Job creation has stalled. There's a lot of factors that are really affecting our economy, and it's not benefiting rates. That being said, there's still opportunities, and the opportunities will always be there. It's just how you're approaching your strategy. How are you, receiving this data? How are you making sense of it? What are you doing to move forward with your data? What does this mean for you? What does it mean for investors? What does it mean for the end consumer? How are rates affecting the person that, if you're going to flip a property, that is an end user, first time home buyer, if they're going to buy it, what do you need to do? Do you need to prepare your property so that when that first time home buyer is coming in, knowing that their rate's going to be higher, are you offering them some incentives to buy down their mortgage? Are you delivering a product that's turnkey, meaning yes, their payment's higher, but because that they're not going to have money to make any upgrades to the house, right? So those are the shift in mentality that you think about when you're taking in all that data that I think a lot of people miss. They're just, they're on rinse and repeat, and they're not evolving into how that market's changing. And that's why I see a lot of properties that people have flipped, people adding ADUs and doing all these things and just not taking into consideration that exit and how that end user is going to view that. If it's shifting your strategy and, hey, I'm going to leave the house per se simple, but I'm going to add an ADU because now I know that the end user, that consumer that's going to buy it, first time home buyer, can move in a relative. It's going to rent out that ADU to offset the difference in interest rate, right? So now you're using your head to think of strategy. How am my CapEx, how is that my value add into a property? How is that increasing value, not only for me, but to make it more appealing for that end user, right? So all those things are things that I think, and as we're seeing the ebbs and flows of the market and continuously being up to date with data, continuously being up to date with the market, continuously being up to date with the Fed and the announcements. And again, not getting lost in the minutia of all of those things. And that's what I'm here for, right? If you want to know, just ask me questions. Because again, I'll bore your ear off for an hour about the Fed. But again, just wanting to shed some light on how that's determined. I was going to talk about private lending and how those interest rates are factored in. But we'll leave that for another time at a different episode and just kind of go into that part of it. Because it's a little bit different and how that's determined. But I think it's again, same approach, same, your cost of money is either 5%, 9%, 11%, whatever the cost of your money is going to be. How do you factor that into your equation? How do you put that in a position where you're still profitable with your purchases? Again, this same concepts need to be tweaked a little bit for every investment vehicle. Asset class that you're looking at, same ideas, I think, that you're looking at, that you should be looking at, right? Because commercial property is a little bit different, industrial is a little bit different. Same approach. So again, just trying to shed some light on some of those things, give some information about the Fed, give some information about rates, inflation, get a little nerdy at times. So I hope you guys enjoyed the episode. If you have any questions, drop them in the comments, reach out, follow, share our content. We're trying to grow out there, guys. We're really trying to make a push to give you guys content that makes sense, adds value to you and your portfolios. So hope you're listening, like and follow for more. Thank you.